ways to consolidate the debts that you have. Because in today's society, many people have got a lot of money out on consumer debt. So that's high purchases, cars on loan, credit cards, etc. And so what they're finding is that when they come pay all their payments every month, they're really struggling to make all those payments. So they're considering consolidation as an option. So what consolidation means is you take all of those debts that you have and then put them into one loan and then just focus on paying that one loan off. Now, I kind of sit on the fence about whether this is a good idea or a bad idea. And I think for a lot of people it is a bad idea. And the reason for that simply is that what I've seen is a lot of people have taken their credit cards and their debts, they've consolidated it into one loan, so they've kind of moved the problem a wee bit to the side, but then what they've done is then gone and maxed out their credit cards again. So they haven't actually made any progress. Now, because consolidation only works if you actually consistently pay off that loan. So you take all those debts, put it into one loan, and you have a very strict plan on how you actually pay that off on a monthly basis. So what that's all about is, again, having a discipline and having a plan, because if you don't have those things, in my view, consolidation doesn't work. One of the options you can use for consolidation is actually taking those loans and putting them into your mortgage. However, what we're going to do is look at an example, and which will clearly illustrate what I mean about whether consolidation is a little bit iffy about whether it can be a good thing or a bad thing. So if you look at the table in front of you, what you'll see there is we've got three different types of loans. The first one is a mortgage. So let's assume that if you take all of your different debts that you have and put it into one loan of $10,000 and you put it into your mortgage, you're going to be paying about 9% interest. But the likelihood is that you'll pay that mortgage off over a 25-year term. And so if that's the case, your payments drop right down to $83.92 a month, but the total interest that you pay over those 25 years is $15,203, which is a lot of interest on that $10,000. Now, of course, if you did pay that loan off over a much shorter period of time, i.e. 4 years, it would be worthwhile for you to do. The challenge is not many people do that because they just lump it into their mortgage and pay on the same time frame as they would as what their mortgage is. So if we look at the next line down, we've got a secured personal loan, and that's probably secured against some assets that you have. Let's say that the loan again is $10,000. Well, you may be paying an interest rate around about 15%. The period of the loan is probably 4 years. Your payment per month is $278 a month, so it's much, much higher than what we had when we put it into our mortgage. But the total interest we pay over that period, because it's shorter, is $3,358. And then if we go down to the last line and we look at an unsecured personal loan, which is probably what I'm finding most people end up having when they're consolidating their debts, same amount again, $10,000. The interest rate is possibly around the 25%, and the period of the loan 4 years again. The payments per month are $331, higher again, and the interest is $5,907. So, you know, there are three different examples, and I guess the key thing is that when you consolidate into your mortgage, you often pay over a much longer period of time, so therefore you're paying a lot more interest. So, you know, you win on the fact that your payments per month are lower, but it's going to cost you a lot more over a long period of time. And then the downside, or thing you've got to watch out for when you consolidate, is that then you go and rack up your debts again on your credit card. Okay? So the key thing to deciding whether consolidation is going to work for you or not is simply about whether you have the discipline to stick to a very strict payment plan to actually get rid of all your consumer debt, rather than just moving it to the side and then increasing your debt in another format. So it can be really effective, but those two key things again are discipline and having a plan.